Eastern Europe is on the edge of a cliff right now. And if you understand what Warren Buffett sees with his record $381 billion cash position, you'll understand why this could hand Putin his biggest victory without firing a single shot, and why it's about to cost you money. This isn't about tanks or missiles. This is about trust. Trust in America. Trust in the dollar. And when that trust breaks, your retirement savings take the hit. Let me show you exactly how this works, because Buffett already positioned for it 2 years ago. Warren Buffett is sitting on $381 billion in cash. That's not a typo. $381 billion. The smartest investor in history is refusing to buy stocks, refusing to buy companies, and just sitting on a mountain of cash bigger than the entire economy of Israel. Why? Because he sees a specific scenario playing out right now that could reshape global power and destroy the value of every dollar in your wallet. And it starts with what's happening in Poland, Romania, and the Baltic states. For 75 years, America has had a security arrangement with Europe where U.S. military presence helps stabilize the region. But in recent years, debate has intensified about whether this arrangement is sustainable or fair. The Trump administration argues European allies should contribute more to their own defense. Through policy documents and public statements over the past 18 months, signals have been sent that American military commitments, particularly to Eastern European countries, may become more conditional on economic contributions. Poland is being asked to increase defense spending from 2.5% to 3% of GDP. The Baltic states, Lithuania, Latvia, Estonia, are being told American troop presence depends on their contributions. Romania faces similar pressure. These aren't suggestions. These are conditions. Supporters of this approach say it corrects decades of imbalance where wealthy European countries underinvested in defense while running trade surpluses and relying on American protection. Critics worry it could weaken deterrence against adversaries and damage alliances. Whatever the merits of either position, currency markets are responding to signals of change, and that's what affects your money. Before we go further, let me be clear. This is educational analysis based on publicly available information, not financial advice. I encourage you to verify everything independently and consult licensed financial professionals for your specific situation. Now let me show you why Eastern Europe specifically matters to your retirement account. These aren't wealthy countries. Poland's per capita GDP is about $18,000. Romania's is $15,000. The Baltic states are small. Lithuania has 2.8 million people total. But here's what makes them critical. They've been the most loyal holders of U.S. dollars in the world. Poland holds $175 billion in reserves, 82% in dollars. Romania, $65 billion, 76% in dollars. The Baltics combined, $45 billion, mostly dollars. That's approximately $285 billion total. These are frontline states that trusted American protection enough to keep almost all their national savings in American currency. Why did they do this? Because they believed the American security guarantee was absolute. If Russia threatened them, Article 5 of NATO meant America would respond. That guarantee was worth more than gold. It was worth holding dollars even when the euro was right next door. But when that guarantee becomes conditional, the financial calculation changes instantly. Now here's why this matters for Putin specifically, and why Buffett's positioning makes even more sense. Putin doesn't need to invade Poland or Romania to win. He just needs America to step back. Here's the math that matters. Right now, Eastern European countries spend approximately $150 billion per year on their militaries combined. Russia spends $86 billion according to Stockholm International Peace Research Institute data. But here's the critical part. Those Eastern European countries can afford their current defense spending because they feel secure under American protection. They can focus on economic growth, education, and infrastructure, while America handles strategic deterrence. If that American security guarantee becomes uncertain, those countries face an impossible choice. Option 1. Double or triple their defense spending to protect themselves independently. If Poland goes from 2.5% of GDP to 5% on defense, That's an extra $30 billion per year that has to come from somewhere. Healthcare, education, pensions, infrastructure. Their economies would slow dramatically. Their citizens would suffer. Their governments would become unstable. Option 2. Make accommodations with Russia. Not military surrenders. Economic arrangements, energy deals, trade deals, diplomatic neutrality. We won't join anti-Russia coalitions. You don't threaten us. This is exactly what Putin has wanted for 20 years, a sphere of influence without the cost of occupation. And here's where your money comes in. If Eastern European countries start making economic accommodations with Russia, they're no longer reliable holders of U.S. dollars. They start hedging. They buy euros. They buy yuan. They buy gold. They diversify away from the currency of a country whose protection they can no longer count on. That $285 billion in dollar reserves they hold, it starts moving. And when it moves, it triggers the exact chain reaction Buffett is positioned for. This is financial warfare. Putin doesn't need to fire a shot. He just needs America to create enough uncertainty that Eastern European countries start looking for other options. And the data shows it's already beginning. According to the International Monetary Fund's COFR data from Q2 2025, the dollar's share of global reserves has fallen to 56.32%, the lowest level in 30 years. Just one quarter earlier, it was 57.79%. That's a 1.47 percentage point drop in 3 months. While some of this reflects exchange rate movements, the underlying trend is clear. Central banks worldwide are reducing dollar dependence. And Eastern European central banks are part of this trend. They're not announcing it publicly because they don't want to anger Washington or signal weakness to Moscow. But the data shows it happening. Let me paint you a picture of what this looks like on a map. Imagine Eastern Europe as a wall. Poland, Czech Republic, Slovakia, Romania, Hungary, the Baltics. For 30 years since the Cold War ended, this wall has been backed by American military power. Behind that wall, these countries built democracies, joined the global economy, and held dollars because they trusted America. Now imagine that wall starts to crack. Not because Russia attacks it, but because America steps back. Poland looks at Lithuania and says, "Are the Americans really going to defend you?" Lithuania looks at Romania and asks the same question. When nobody's sure, everybody hedges. They start buying euros. They start buying gold. They start quietly talking to Moscow about gas deals and trade arrangements. Not because they want to, because they have to survive. And Buffett sees this. He sees the wall cracking. That's why $381 billion sits in cash. Now let me show you exactly how this affects you. When foreign countries sell dollars and U.S. Treasury bonds, interest rates rise. The U.S. government currently pays $970 billion per year just in interest on the national debt. That's according to Treasury Department data from fiscal year 2025. That's nearly $1 trillion just to service debt. It's more than we spend on our entire military. That $970 billion equals $7,300 for every household in America. That's money that could have gone to fixing roads, lowering your taxes, or protecting Social Security. Instead, it's going to bondholders. If interest rates were to rise by just 2 percentage points because foreign demand for Treasury bonds declines, that annual interest bill could increase by $600 to $700 billion according to Congressional Budget Office projections. Where would that money come from? 3 places: higher taxes on you, cuts to Social Security and Medicare, or printing more money causing inflation. There's no fourth option, but it gets more personal than that. Let me introduce you to Tom Richardson. Tom's 58 years old, an electrician in Phoenix, makes $72,000 a year. He's got $340,000 in his 401k, mostly in an S&P 500 index fund. He's planning to retire at 65. He thinks he's done everything right. But here's Tom's problem. If the dollar were to weaken by 20% because countries like Poland and Romania are quietly moving away from it, Tom's $340,000 doesn't change on his statement. It still says $340,000. But what that money can actually buy could drop by $68,000. Why? Because America imports a huge portion of what we consume. According to Commerce Department data, approximately 40% of consumer goods are either imported or contain imported components. Your phone, made overseas. Your medications, active ingredients from abroad. Your winter produce, from Mexico. Your gasoline, refined from imported crude. If the dollar drops 20%, all of that becomes 20% more expensive overnight. Tom's $340,000 is still $340,000 on paper, but it buys what $272,000 used to buy. He just lost $68,000 in purchasing power without selling a single stock. And here's the invisible part. His brokerage statement looks fine. Most Americans wouldn't even realize it's happening until they go to the grocery store and can't understand why everything costs so much more. This is what's called currency depreciation. It's a wealth transfer that happens silently. According to AA, the average household spends about $3,000 per year on gasoline. If the dollar drops 15%, that's an extra $450 per year just to drive to work. But multiply that across everything you buy that's imported or uses imported components. A household earning $60,000 per year could effectively experience a $6,000 reduction in purchasing power. For retirees on fixed income, it's even worse. Social Security provides cost of living adjustments, but they're based on official inflation measures that may not fully capture currency effects. You fall behind month after month, and you might not even understand why. This is why Warren Buffett saw this coming and positioned for it. According to Berkshire Hathaway's official earnings release from November 1, 2025, Buffett is holding $381.67 billion in cash and treasury bills. During the 2008 financial crisis when banks were collapsing, he held $44 billion. Today, he's holding 9 times that amount. During the dot-com crash, about $30 billion. This current position dwarfs every defensive stance he's ever taken. Buffett doesn't do this because he's pessimistic about American businesses. He does it because he understands currency risk, and he understands geopolitics. He sees the Eastern Europe situation not as a military problem, but as a confidence problem. And confidence problems in currency markets turn into currency crises. And currency crises transfer wealth from the unprepared to the prepared. Let me show you the chain reaction Buffett is positioning for. Step 1. American security commitments to Eastern Europe become conditional. Step 2. Eastern European countries lose confidence in American reliability. Step 3. They quietly diversify their $285 billion in reserves away from dollars. Step 4. Other countries see this and think, if the most vulnerable countries are leaving dollars, maybe we should too. Step 5. Dollar selling accelerates. Treasury bond prices fall. Interest rates spike. Step 6. U.S. government debt service costs explode from $970 billion to $1.5 trillion or more. Step 7. To pay that, they raise your taxes, cut your benefits, or print money causing inflation. Step 8. The dollar weakens further. Imports get more expensive. Step 9. Your paycheck buys less. Your retirement buys less. Your savings erode. Step 10. Buffett deploys his $381 billion to buy quality assets from desperate sellers at huge discounts. That's the playbook, and it's already in motion. Now you might be thinking, can't the government just stop this? And that's the hard truth. Once confidence breaks, traditional tools become less effective. The Federal Reserve can print dollars, but it can't force foreign countries to hold them. The Treasury can issue debt, but it can't force foreigners to buy it. This is exactly what happened to Britain after World War II. They tried to maintain the pound as the world's reserve currency, while using it as political leverage. By 1967, the pound collapsed as a reserve currency. Britain never recovered that dominance. History is clear. You cannot weaponize your currency for short-term policy goals and expect it to maintain long-term trust. Markets respond to reliability and predictability, not to ultimatums. Here's what you need to understand. Buffett can afford to wait years for the right moment. He doesn't have bills due next month. He can sit on $381 billion and be patient. You probably can't. If you're like most Americans living paycheck to paycheck, you can't hold cash for 3 years waiting for a crisis. You have a mortgage, car payments, insurance, groceries. If economic disruption occurs and you lose your job at the same time, you might be forced to sell retirement assets at the worst possible moment. That's how wealth inequality accelerates during crises. Wealthy investors have time. Middle-class families don't. They sell at the bottom to survive. Then wealthy investors buy those assets cheap and profit when everything recovers. I can't give you financial advice. Talk to a licensed professional about your specific situation. But I can tell you what Buffett's positioning suggests. First, he recognizes that cash has strategic value during uncertainty. When others desperately need liquidity, having cash provides enormous optionality. Second, he favors businesses with pricing power, companies that can pass cost to customers regardless of currency fluctuations. Essential services and strong brands maintain real value better during currency stress. Third, he's wary of debt during volatility periods. While inflation can help borrowers, that only works if income keeps pace. If inflation runs 8% but salary grows 3%, you're falling behind. Most importantly, psychological preparation matters. If currency volatility occurs, your statements might show concerning numbers. The instinct will be to panic and sell. That would likely be the wrong move. That's when Buffett deploys his $381 billion to buy from desperate sellers. Let me address what everyone's thinking. Is Trump actually handing Eastern Europe to Putin? From a military standpoint, that's a political debate with legitimate arguments on both sides. But from a financial standpoint, here's what's undeniable. Putin doesn't need to win the military argument. He just needs to win the economic one. If Eastern European countries lose confidence in American commitments and start hedging their bets, economically, financially, diplomatically, Russia gains influence without firing a shot. The sphere of influence Putin has wanted since the Soviet Union collapsed gets handed to him through financial pressure, not military conquest. And here's the part that should concern every American with a retirement account. When those countries hedge by moving away from the dollar, they trigger the exact currency crisis that erodes your purchasing power. Buffett saw this two-level game, the geopolitical game and the currency game, and positioned accordingly. His $381 billion cash position isn't about being pessimistic about America. It's about being realistic about what happens when American reliability gets questioned. The Eastern Europe situation is the trigger. The dollar crisis is the consequence. And your retirement savings are caught in the middle. This isn't about politics. This is about understanding structural forces. When the foundation of global finance, trust in American commitments starts to crack, everything built on that foundation becomes unstable. Warren Buffett understands this. That's why the most successful investor in history is sitting on more cash than he's ever held, while everyone else is chasing stocks at all-time highs. The question isn't whether you support or oppose any particular policy. The question is, are you prepared for what happens if confidence in the dollar continues to erode? If you found this analysis valuable, if you appreciate the effort to connect geopolitical events to your financial reality in straightforward terms, I'd appreciate a like on this video. It helps this reach people making real financial decisions, not just consuming headlines. Thank you for watching. Verify everything through your own research. Consult licensed professionals about your situation, and understand that all analysis involves uncertainty. Your financial security is too important to trust anyone blindly, including me.